All right, guys, so in this lesson, we're going to be talking about sizing your positions, how to properly size a trade. It's pretty simple. It's not too difficult. It just requires literally one or two calculations, and I'll show you exactly how to do that on the charts. And remember that majority of the brokers, the broker platforms out there, they have already tools built in that allow you to properly size a position. So in the previous lesson, we talked about risk management, right? So I mentioned how I personally size my positions based on 1% of my account size, right? So that's exactly what I'm going to show you. I'll show you exactly how to obviously calculate your 1%, which is a very simple calculation, but also how to size the position based on that 1%. And I'll show you some tools, some calculators and stuff like that that you can already use. And again, it's going to be a quick lesson, a very short one, but much needed lesson because you're going to need this before we dive into the strategy lessons, which there are next. So with that said, guys, let's hit the charts and I'll show you exactly what I'm talking about. All right, guys, so now that we're going to look at the charts, we're going to again look at how to size a position. So here I just have a random trade, and this is a swing trade. So let me actually explain the trade really quickly since we're already getting close to the strategy. So let me just quickly explain it and then I'll show you exactly how to size a trade, okay? So higher time frame, this would classify as an initial breakout strategy. So the first strategy that you're going to learn, this is it. This is the initial breakout, and this specifically, this will be an initial breakout B, and I'll explain why in a second, okay? So initial breakout B. And the way it starts off is you need a very strong rejection or reversal on a higher time frame, right? So since this is swing trade, so we're going to look at the monthly, the weekly, and the daily, right? This can also be applied as a day trade if you look at the 4-hour and the 1-hour as well, and then take the position on those time frames instead. It would be a much smaller entry size and therefore a much larger reward risk ratio, okay? But simply, this has confluence factors on all time frames, so we have this monthly bearish engulfing right here, okay, rejecting the previous highs. So we have a monthly bearish engulfing, rejecting the highs, but it's a pullback trade, okay? You're not trading with the trend because you can see here, the trend was bearish, right? Making lower low, lower high, lower low, lower high, lower low, until it eventually exploded to the upside, making massive higher high, okay? So this is just a pullback play, okay? Chances are this might continue a little bit higher, just kind of, it will need more development for this to turn massively bearish again like it was over here, okay? Simply just because of this recent big breakout that we had. So pullback on a monthly, so it's not going to be a long-term position or anything like that, it's just a simple pullback play. Then the lower time frame should be confirming it. It should give us a little bit more confirmation. Again, we're going to explain this fully as we go into the strategies, which is pretty much next, right? But it's just a quick introduction. So the higher time frame has the rejection, has the candlestick formation. It's the run. You're targeting the pullback in this case. The weekly time frame in this case should have a little bit more development, okay, trend-wise. So what do we have here? This is, let's talk about Elliott waves. Wave 1 breakout, wave 2 pullback, wave 3 biggest run, wave 4 A, B, C pullback, okay, simple pullback, complex pullback, wave 4 finished, wave 5 didn't continue any higher, wave 5 has finished, price action fell to the downside, okay? So at the top of it all, we also have bearish MACD divergence. So we're starting to develop bearish bias here. The bullish trend on the weekly time frame is coming to an end, which means, there's a very good potential that the monthly pullback is actually going to happen, okay? Because the weekly trend, it looks like it came to an end, or potentially came to an end with this wave 5 coming to a close, okay? Plus bearish MACD divergence. So on the weekly time frame, we're starting to confirm the monthly bias. Then the daily chart should take it a step farther, and the daily chart should have full confirmation, okay? Do we have it? So the daily chart was in this bullish trend, okay? So as the monthly chart was riding up, the daily chart was kind of trending upwards here slowly. And then we had this massive move to the downside, breaking down below the daily 50 EMA, and then coming back for a retest of that daily 50 EMA. The daily chart has a trend change. The daily chart has a breakdown and a potential lower high developing at the time of the entry. So we have full confirmation here. The monthly chart has that bearish engulfing, the rejection, playing the pullback. The weekly trend is at the end of its cycle. Wave 5 has come to a close. We have bearish monthly divergence. Okay, chances are there might be a trend reversal. And a daily chart does have that trend reversal of this breakdown and the lower high on the retest of the daily 50 EMA and 0.382 Fibonacci retracement. Okay, so we have all of that. And let me just delete this for a second. So that's again simply how an initial breakout looks like. Now, target wise, if you look at, I'm going to fully explain this in the strategy lessons, guys, but this is just a warm up. So since it's a pullback play, it's not a long-term position. You know, pullback play, this would be targeting like the monthly 20 EMA if you wanted to stretch it. But you see how on the weekly chart it's not that much farther down, the monthly 20 EMA, just a little bit farther. So sure, you could push there, but if you look at the weekly 50 EMA, it's a very good dynamic support and resistance level. You got one rejection here, two rejections here, third rejection, you know, so it is a very good fourth rejection, fifth rejection. So the 50 EMA on the weekly chart is amazing. It's a great support level. So do you want to trade through that? That's the question. Would you want to trade through that? Personally, no. Personally, I wouldn't. This support level, it is too strong for me to trade through it, specifically on a pullback play. Okay? If this was with the trend on a monthly chart, if I was going long, or if it was just with the trend instead of a pullback, then I would definitely consider it because the reward risk ratio would have been much higher. Okay? But in this case, since my target on the pullback play would just be a little bit below that weekly 50 EMA, targeting that monthly 20, right? So in this case, it makes more sense for me to target the 50 EMA on the weekly chart instead because it is a very strong support level. Okay? So my target would be that. So now when we look at the daily chart, well, it makes sense then for me to target the daily previous low right here. Okay? And that lines up pretty well with the weekly 50 EMA. A little bit above, right? So that would be my target. So you see how everything's kind of lining up together when I explain the strategy, right? You get the monthly reversal, you got the weekly trend change starting to happen. The weekly 50 EMA is a very strong support level. Since it's a monthly pullback, it's only a quick play. Okay, it's a pullback play. And since this weekly 50 is a strong level, then a good place to target on a pullback would be this weekly 50. But that also lines up pretty well with the previous daily lows. So might as well just target the previous daily lows instead. Right? So that's kind of the mindset behind the trade. Okay, behind this trade. So since it's a swing trade, you know, personally, a swing trade for a quick one-to-one, because this will be only a one-to-one option, and for a one-to-one trade, this, for some, it might not even be, for some people might not want to sit 2 weeks just for a quick 1% trade, okay? And I'll show you exactly other options on how to take different positions that give you a higher reward risk ratio. Okay, and a swing trader might just focus on the trades that have a higher reward risk ratio, and a day trader would focus on more of these quicker positions. This trade could have also been taken as a day trade at the exact same time for much more profit. Okay, and that's something again we'll learn in the strategy lessons themselves and the lessons following the strategy lessons. But in this lesson, position sizing, how to size a trade. So now that we know that this is an initial breakout strategy, okay, specifically initial breakout B out of the 3 initial breakout strategies that I will explain, the entry would look something like this. Okay, so you see how we have deceleration on the daily 50 EMA and 0.382 Fibonacci on that breakdown and the retest, deceleration, beautiful bearish engulfing candlestick. That's where the trade would be. It would be right after that daily candlestick. Okay, targeting the lows. The stop loss would be somewhere around 0.618, okay, as a one-to-one. this is how a simple position size would look like, okay, for a day trade, for a swing trade. Now there's different management options as well, and I'll show you. For a swing trader, if you look at the lower time frames and notice that there's a trend change, then you might want to tighten that stop loss a little bit more, you know, and just kind of put it above the high. And I'll explain that when we dig into the strategy lessons, right? But that gives you only a little bit more reward risk ratio, 1.4 instead of just 1-to-1. So there's options, but for now, let's just keep it simple. Let's focus on what a typical, just a normal IBO, quick IBO pullback play would look like, okay? And it would look something like this. So just a quick 1-to-1. So now we need to size it properly. So we know that we want to enter somewhere over here. We know that we want to keep our stop somewhere over there, around 0.618. We know we want to keep our target somewhere at the lows. So we have a 170 pip target, and therefore we also have a 170 pip stop loss. Lines up perfectly together. You know, it's exactly how I want it to be. To stop loss at 0.618 fib and target at the previous lows and the weekly 50 EMA. Perfect, 1-to-1. Okay, so 170 pip stop, 170 pip target. So we need to know the difference between the entry price and the stop loss price. So using a tool like this, it already tells you the difference. Okay, it's 170 pips, that's the difference. But if you want to calculate it, then it will be the difference between entry price, which the entry price here is 0.89. Let's just make it an even number. So the entry price is 0.892. Okay, it's just an even number, easier for calculations. So that's the entry price, 0.892. The stop loss price is 0.9090. Okay, the difference between the two numbers is the number that you're focusing on, is the distance, it's the 170 pips, you know? So take 0.9090 minus 0.8920, and you're gonna get 170 pips. Okay, so that's the difference. So majority of the drawing tools will already do this for you. We'll just calculate it right for you. We'll show you the pip distance away. Okay, so the pip distance is 170 pips. So let's do a couple of calculations. First thing what you need to figure out is what is your 1% risk. Okay, so as we learned in the risk management lesson, it's important to know what your 1% risk is. Okay, because you'll be risking only 1% of your account size per trade. So the difference here, this 170 pips, is 1%. So every 170 pip move, you make or lose 1%. Okay, that's what we need to do. We need to size it in a way so that 1% equals to 170 pips. Okay, so how do we do that? Well, first we need to figure out what is the 1%. So let's say your account size is $50,000. Okay. What is 1% of $50,000? Well, 50,000 simply divided by 100. So 1% of 50,000 is 500. Okay? So $500. That is your 1% risk. Your 1% risk is $500. So it's always whatever your account size is, whether it's 50,000, 100,000, 10,000, is just divided by 100, and right away you have your 1% risk, which is $500 in this case. Okay? So we know that if we enter this position and it goes against us and hits our stop loss, we're gonna lose 500 bucks. If we enter this position and it hits our target, like in this case, we're gonna make $500. Not bad, right? So that's the first number that we need to figure out. Okay, so the risk. Then the second number is obviously the difference. Okay. Between this, so we already know the difference is 170. We already know the calculations. Just take the one number divided by the minus the other, and you're gonna know the difference in pips, 170 pips, right? Or just use a drawing tool like this, and it will show you exactly the difference. It's 170 pips. Okay. So now that we have these two numbers, you need to figure out the pip value. Okay. So the pip value. So how much is one pip worth? Okay, so how much is the one pip worth? So you simple, you take $500, okay, because your 1% risk is 500 bucks, divided by 170. So one pip is worth $2.9. That's it, $2.9. Okay, so every pip move you make $3 pretty much. If it goes one pip in your direction, you make $3. Doesn't seem like much, but you know, when you're looking at the bigger numbers, you're making 500 bucks. So that's the basis. Okay, that's the basis of these calculations. First, you need to figure out your 1% risk. Let's just summarize. So figure out your 1% risk. Let's say your account's 50 grand. Divide that by 100. You get your 1% risk, $500. Okay. Then figure out the position sizing. So your stop loss is 89, or sorry, your entry is at 89.20. Okay. Minus the stop loss 9090. You got 170 pips. Simple. You know, so now we know the difference between the entry and the stop loss is 170 pips. Or just use a drawing tool like I have used here and it will tell you exactly. Okay. So the next, figure out what is the 1 pip worth. What is the pip value? So you take $500 divided by 170 pips, and 1 pip is worth $2.9. Okay, so now you take this $2.9, you take it to your brokerage, okay, because every single brokerage is a little bit different. Some brokers already have like this calculator built within it. Some brokers don't have this calculator built within it. If a broker does have a calculator built within it, then you just size the position properly. You will have to learn it on the broker side. Every single broker has a different platform, you know, so that's why I'm not going to show you that here, because every single broker is different. So you're just going to have to learn how that broker works, and they have their own documentations and tutorials and stuff like that, you know, so you can just look into that. But now that you know the pip value, $3 per pip, so you size your position based on $3 a pip, okay? Or a simpler way is to use a calculator, okay? And by using a calculator, you can just go on Google and search position size calculator. And if you search position size calculator in Google, you're going to get a bunch of calculators that will calculate the position size for you, okay? In FX, it's a little bit different because in stocks, we would be using the same calculation, and right away, we would know how many shares we would have to buy. Right away, you know, you would just know how many shares you're buying by just doing this calculation. But in FX and Bitcoin cryptocurrency is the same thing. You just do this calculation right away, you know how much you need to buy or sell. In FX, it's a little bit different. Why? Because since the movements in FX are so small, like literally you're just moving from 0.892 to 0.909. It's a very tiny movement, you know. You're not moving $1, you're not moving $3, you're not moving, you know, $100 or $500 like in Bitcoin. You're just moving a few cents, you know. So to make money in a few cents, you have to leverage up. You need to trade with leverage, you know. And the values that we use, the position sizes that we use in FX are a little bit different. It's either going to be units. It's going to be based on units, and this is terminology you should already know, or lots, you know, so it just really depends on how your broker works. It's either units or lots. So the broker will typically have, again, something like this already built within it. You might just have to figure out that pip value that we did. You know, that's typically what you have to do. You have to figure out the pip value, and then the broker will calculate the units and the lot size for you. Or you just use this calculator. So this is a euro pound position. So we have a euro pound currency pair selected. Look how easy it is. My account size is 50 grand. Okay. My risk is 1%. My stop loss is 170 pips. Boom, calculate. Now money risk is $500. The units that I'm supposed to buy or sell is 23,100. The lots is 0.23. Done, period. Easy, simple, you know. So using a position size calculator is the easiest way to do it. I showed you the harder way to do it and the easier way to do it, you know. So the harder way to do it is just do the calculation yourself, okay, and figure out the pip value, what is 1 pip worth, and then take that 1 pip value to the broker side, and that's how you're going to be inputted into your broker side, you know, into your entry on the broker platform. You know, you typically have to know the pip value, but every single broker is different, so that's why it's good to know how to just calculate it using just normal formulas, because every single broker, again, is different. Or simply, you know, just take this calculator, easy position size calculator, just Google this, and you're gonna get a bunch of them. The one I use is one by a journal. You can use my FX book as a journal as well. And this calculator is pretty good, so I just have it saved in my bookmarks, and whenever I'm sizing a position, boom, I just whip it out, put the values in, and I know exactly how much I need to buy or sell, right? Easy. So that's it. That's how you size a position. So now that you know how to do this, we're getting into the strategy lessons next. So since we're getting into the strategy lessons next, you're gonna know exactly how to do this, exactly why the entry is like this, exactly why the target is like this, exactly why the stop loss is like this, and we'll talk about all the different variations and targets and stop losses and entries, for every single strategy. So here is just a little taste of what's possible. This is just a quick play because again, it's a pullback play and there's not much room to move. Remember that it's a pullback play and there's not much room because of the 50 EMA. Since the 50 EMA is a good support level, there's not much room to move. So we have to target that 50 EMA in the previous lows. In this case, it's only a quick 1-to-1. If you take it as a day trade, you're going to be entering on a much smaller time frame, and chances are you can probably take 3% out of this position because your entry would be smaller, but then you risk potentially being stopped out, right there. A little bit more risk with day trading. But that's it for this lesson, guys. So I'm going to wrap it up and we're going to dive right into the strategy lessons next. So that is it, guys, and I'll see you guys in the strategies.